Today, we are reviewing a structure for a video report titled UP 54% in one day. Is RUBI the best penny stock to buy now?
Quite the title.
It is. It dives into the wild volatility of Rubico Inc., analyzing its secured tanker contracts and this huge financial gap between its, $120.8 million revenue backlog and its tiny market cap of about $14.6 million.
A massive disconnect.
Exactly. So let's just jump right in. Okay, so what this structure does brilliantly, right off the bat, is it identifies what we're calling the golden number. That spread between the $120.8 million in secured revenue and the $14.6 million market cap. I mean, it translates to a jaw-dropping 0.12 price-to-earnings ratio. That's the hook.
It's an incredible hook, utterly compelling. But, that's also where the first problem starts, if we're being honest.
How so?
The analysis structure clearly identifies its valuation disconnect, but it needs to more intrinsically link the reason for that absurdly low PE to the inherent risks, the shipping sector, its microcap status.
Right.
When you throw out a 0.12 PE, you're basically telling the viewer the market is missing, 99% of the value? That's a huge claim to make without immediate qualification.
That's a fair point. The report has to earn the viewer's trust by showing it understands why that number exists in the first place.
Exactly.
As it stands, the structure kind of risks presenting this low valuation purely as some giant oversight by the market.
Which rarely happens in finance.
Yeah, instead of accepting it as a necessary risk premium, the market is pricing in the fear.
Precisely. And right now, the risks, the probability of future dilution or debt, they're sort of tucked away in a single bullet point under the bear case section.
Way at the end.
Right, and that separation weakens the intellectual honesty of the bull case. You're presenting this spectacular fundamental value without immediately acknowledging the structural headwinds that are keeping the price pinned down.
So if dilution is the reason the stock is only 25 cents, you need to bring that conversation forward.
You have to. So my suggestion is this. The material should proactively address the microcap risk, the volatility, immediately after presenting that revenue backlog.
Okay.
Use that contrast to really deepen the sense of a high-stakes analysis. You're transforming it from, look at this overlooked gem, to something more like, this gem is sitting on a live wire, and here is how we handle it.
But isn't there a risk that, by bringing up the bad news so early, right after that golden number, you might just scare the audience away?
I don't think so. Not if you frame it right.
Okay.
You turn the bad news into a challenge. The skeptical challenge the viewer needs to overcome to even justify the investment.
So make it part of the puzzle.
Exactly. So to make this actionable, I'd suggest restructuring the flow. Immediately after you present the $120.8 million backlog and the 0.12 PE, you interject with that warning. Frame it as the skeptical question the market is asking right now.
So you're saying something like,
Yeah, like instead of listing the risk later, you could say, this $120 million backlog gives us a 0.12 PE. That's a 99% discount. So why? Because the market knows the history here. With microcap shipping, every growth opportunity comes with the risk of dilution or debt, and that's the shadow holding this stock down.
that creates immediate tension. I like that.
It does. Or another idea. You could take that powerful metaphor, the small boat in a big ocean, which is currently buried in the conclusion,
Right.
and introduce it much earlier. Pair it directly with the 0.12 PE ratio to explain why that number is being so heavily discounted. It needs context now, not later.
I really like that transformation. By weaving the dilution fear directly into the fundamental analysis, you elevate the credibility and the drama at the same time. You're showing viewers you get the game.
You get the whole picture.
Okay, let's pivot to the audience strategy. The report currently handles this by offering two different paths in the conclusion. One for day traders monitoring the $0.25 break, and then just general caution for long-term investors.
And that distinction is a great foundation, but we need to look at the depth offered to each group.
Okay.
So while the structure differentiates between day traders and investors, the really heavy emphasis is on short-term price targets, right? The $0.29 resistance, the $0.50 momentum run.
Yeah, it's very trader-focused.
It is, and that means the structure really underserves the investor who needs deeper, more specific due diligence.
Right.
The weakness here is all about specificity. The structure gives a lot of space to technical momentum triggers, the targets above 20 cents, 29 cents, 50 cents.
Which are great for a day trader.
Super actionable for them, especially with the 54% volatility. But when it comes to the investor who's looking beyond tomorrow, the material just vaguely suggests caution. It totally neglects specific research prompts that go beyond just reading a PE ratio.
An investor trying to hold this for 6 months needs a checklist, not just a vague warning.
Exactly.
So I see the disparity. The day trader gets a map with clear entry and exit points, but the investor gets a philosophical warning to be careful.
That's a perfect way to put it.
Given this is a microcap with secured revenue contracts, an investor's homework should be way more intensive than that. So what concrete steps could we suggest they investigate?
Well, the suggestion is to really bolster that investor component. Integrate prompts for fundamental checks specific to the context here. What justifies the eco-charter extensions, the company's lineage as a spinoff?
The backstory.
The backstory. The investor needs to look at the context of the contracts and the corporate structure itself. Secured revenue is only as strong as the counterparty and the company's ability to execute.
So give them some real homework.
Let's give them focused homework. For example, add a defined step in the analysis that encourages investors to examine the parent company top ships, or TOPS. Because RUB is a spinoff, the parent company's history, specifically around shareholder relations, past capital raises, restructuring, all of that is critical due diligence. You need to know if the history suggests stability or just ongoing financial distress.
That's a huge point. Ignoring the parent company history in a spinoff analysis is leaving the biggest structural risk totally unaddressed.
It is.
And what about the quality of the revenue itself?
Exactly. Investors should also be prompted to research the specific operational capacity and nature of the extended contracts for the Eco Malibu and Eco West Coast tankers.
Dig deeper than the headline number.
Right. We know the total figure, $120.8 million, but we don't know the quality. Is this a long-term charter with a AAA-rated national energy company, or is it tied to some smaller, riskier entity? Are the rates fixed at historically high levels? You see?
Yeah. Providing context for the quality of the revenue. That offers concrete, actionable research steps. It moves way beyond just be careful.
It gives the investor the tools to actually validate the story for themselves.
By giving the investor those specific research angles, the parent company link, the contract quality, you successfully turn general caution into focused, actionable due diligence. It makes the structure complete for both audiences.
That's the goal.
All right, let's shift to the pacing of information. The report contains some vital real-time information, specifically the after-hours pullback to $0.21, which clearly shows immediate profit taken after the spike. This detail is gold.
It is fascinating data, yeah. But its placement is a real missed opportunity for risk management.
How so?
The structure places the most critical, real-time warning about profit-taking way too late. It minimizes its impact on the immediate trading context.
Okay.
The observation that the after-hours pullback to 21 cents confirms profit-taking that's immediate, tangible evidence of selling pressure on a stock that was just up 54%.
Right.
Yet it's reserved for the final conclusion section. By placing it after the report has already laid out all the bullish price action and the momentum targets for 29 cents and 50 cents, you just reduce its function.
It becomes a historical footnote.
A summary observation, yeah, instead of what it should be. An immediate dynamic warning that frames the entire technical analysis.
So the technical targets feel aspirational when they should feel evidence-based. If someone's watching this while the stock is still trading, that after-hours data is arguably the most relevant piece of information they need.
It is, absolutely. So the suggestion is to move that real-time risk assessment forward. Put it right in the report section that discusses price action.
Okay.
Use that profit-taking confirmation to frame the whole discussion of support and resistance. You need to tell the audience, look, we know this stock ran to 29 cents, but it immediately sold off to 21 cents, confirming heavy profit-taking pressure. This grounds the volatility thesis right away.
And makes it feel real.
It makes it feel very real. So, to implement this concretely, instead of waiting until the end, place the observation that the stock cooled off to the $21 to $24 range immediately after noting the 29-cent high and the huge volume.
Right after the big numbers.
Right after. It creates the full picture of the day's action. Then, you can use that $0.21 pullback as the active real-time evidence for why the 20-cent level is such a crucial support point.
Ah, I see. And by doing that, the discussion of the gap filling down to 15 cents suddenly becomes much more relevant, much more urgent. You've just demonstrated that selling pressure is real and already happening.
The support levels aren't theoretical anymore. They're actively being tested.
Exactly. And also, if you have a graphic element like a risk meter, place that earlier too. Maybe when the high volume is first mentioned. That immediately reinforces the volatility thesis and prepares the viewer for what's to come. That flow adjustment is really powerful. It makes the risk-reward discussion feel immediate and urgent. The analysis moves from being a retrospective summary to an active guide on navigating volatility, which is exactly what a viewer needs from a video with this title. So, to recap the main areas for strengthening this report structure, we've identified 3 crucial improvements.
Okay.
First, the core valuation analysis. It needs to be strengthened by integrating the structural risks like dilution fears, microcap volatility, more tightly with the fundamental PE calculation.
Don't isolate the bear case.
Right. Synthesize it with the bull case for greater depth.
Right, and second, we have to expand the actionable due diligence for the investor audience. Give them specific, rigorous research prompts. The spin-off status, the quality of the tanker contracts.
Turn general caution into concrete validation steps.
Exactly.
And finally, optimize the structure by moving that critical, real-time profit-taking warning, the after-hours pullback to 21 cents, forward in the flow. Use that active evidence to frame the entire technical analysis.
Yeah, the overall goal here is to make sure the analysis keeps its punchy, exciting nature while adding that crucial layer of robustness. By threading the specific financial risks throughout the fundamental analysis, instead of just isolating them, you build an argument that's, harder to ignore and ultimately more credible for everyone involved.
For both the traders and the investors?
Right, for everyone navigating the extreme volatility of a stock like RUBI.
We are ready to review this material again. Please send us the revised structure when you've implemented these changes. We look forward to seeing the added depth and credibility.